everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial on the web at elevationfinancial.com. You're welcome to visit me there. Today, we're going to talk about how taxes work in a brokerage account and how to manage them. So, if you've ever wondered how brokerage accounts are taxed, you're not alone. It's possibly confusing to many. It can be confusing, but understanding it can save you money and some stress. So, we're going to talk through how taxes work in a brokerage account. So let's break it down: what's taxed, how it's taxed, when it's taxed, and how to manage those taxes. So first of all, let's talk about what is a brokerage account. A brokerage account can be a great way to invest in things like stocks, bonds, mutual funds, ETFs, other stuff. And a brokerage account can be referred to under many names. It can be also referred to as a taxable account, a taxable brokerage account, an individual account if it's owned by one person, a joint account, or a JTWROS account. That's the acronym you'll see. That's joint tenants with rights of survivorship. That's the acronym you'll see. Or a TOD, which is a transfer on death account. Those are all names that a brokerage account could be referred to. They could all be labels assigned to this one type of account depending on how the institution that it's housed at displays the name of the account. So unlike tax advantage accounts like IRAs or 401ks, brokerage accounts are taxable. That means the government wants a piece of the gains, sometimes in complicated ways. So knowing what triggers taxes can help you plan better. So capital gains, this is the most common type of taxes you're going to encounter. So capital gains can be short-term or long-term. One of the main tax events in a brokerage account is realizing a capital gain. So a short-term capital gain occurs when you sell an investment held for 1 year or less. They're taxed as ordinary income, and so your regular income tax rate is going to apply in this case. A long-term capital gain happens if you hold an investment for more than 1 year before selling, and then when you sell that, the gain qualifies for a lower tax rate. And depending on your income, you'll pay anywhere from 0 to 15 to 20%. So it's either 0%, 15%, or 20% typically. So why does that matter? So holding an investment for more than a year can significantly reduce your tax liability, especially if you're in a higher tax bracket. So that's how capital gains work in a taxable account. Next, let's talk about dividends. And dividends are broken into two categories: qualified versus ordinary dividends. So dividends are another source of taxable income in a brokerage account, and qualified dividends meet specific IRS requirements and are taxed at the lower long-term capital gains rate. Ordinary dividends, however, don't meet the criteria, and they're taxed at your ordinary income tax rate. So you want to understand which of your dividends are qualified and which are ordinary, and that can make a difference in how much in taxes you pay. All right, there's other taxable events that can occur, whether it's interest or events from mutual funds or other ETFs. Interest income comes from bonds or cash equivalents, and interest income is taxed as ordinary income. Mutual funds, however, may distribute capital gains even if you didn't sell anything yourself. Those are taxable in the year that they are distributed. And ETFs, however, are generally more tax efficient, but they can still create taxable events, particularly when you sell the shares, that's a capital gain. So different types of securities inside the account can behave differently. So watch out for those mutual funds, especially because they can often generate distributions, which can be taxable. All right, let's talk about tax loss harvesting. Another tool available to investors is tax loss harvesting. This involves selling investments at a loss to offset realized gains. So you can use losses to offset gains dollar for dollar. If your loss exceeds your gains, you can deduct up to $3,000 of those losses against ordinary income each year. Any excess loss carries forward into future years. So as you're looking into this, watch out for the wash sale rule, because if you sell an investment at a loss and buy back a substantially identical one within 30 days before or after, the loss is disallowed. This is known as the wash sale rule. So avoid that to make sure your losses are truly deductible. So for example, if you're if you have an S&P 500 fund, for example, and you sell it at a loss, and then you immediately buy another S&P 500 fund, that's an identical fund, basically, and the wash sale rule would apply. All right, let's talk about tax gain harvesting. And this is a way to take advantage of income in, or take advantage of this principle in low income years. So tax gain harvesting is a kind of a lesser known tactic, but it can be really effective strategically if it applies to you. So it involves intentionally realizing long-term capital gains in a low income year, which means you can often pay little or no tax on the gain. So the IRS applies a 0% tax rate on long-term capital gains for individuals with taxable income below a certain threshold. So be sure to verify what those thresholds are for the year that you're listening to this in. So if your income falls below those thresholds, you can sell appreciated investments and pay no federal tax on the gains. So why is that smart? Well, by harvesting gains when your tax rate is 0 or low, you reset your cost basis. And this can reduce the tax hit on future sales if you're in a high tax bracket later on. So you're increasing that cost basis, therefore lowering the spread between the cost basis and the potential sale later on. So for example, if you bought a fund for $10,000 and now it's worth $15,000, you could sell it in a low income year, realize the $5,000 gain tax free, and immediately rebuy the same fund. There's no wash sale rule for gains. So your new cost basis is now $15,000, which lowers future taxable gains. So when should you use tax gain harvesting? The strategy is especially useful in years when you're in between jobs or on a sabbatical, you've recently retired and maybe haven't started Social Security or RMDs, or you're expecting higher income in the future. It's a forward-looking way to reduce lifetime tax liability, not just taxes for the current year. So be aware, though, warning, capital gains can affect other things like ACA premium tax credit. So even if you pay no income tax on a capital gain, be sure to review how it can affect other areas of your financial life. So let's talk about estimating and paying taxes on brokerage earnings. So you'll need to account for your brokerage income and gains when filing your taxes. So some key forms to be aware of are Form 1099-B, which reports proceeds from sales, including cost basis and gain loss information. 1099-DIV, which reports dividend income. 1099-INT, which reports interest income. And then on Form 8949 in Schedule D, that's where your gains and losses are calculated and summarized. So if you realize a significant amount of income from a brokerage account, consider adjusting your estimated tax payments to avoid penalties. So what are some tax efficient planning tips to be aware of? So one, hold investments long enough. So try to avoid selling before the 1 year mark because you'll then benefit from long-term capital gains rates if you hold them for more than a year. Also, choose tax efficient investments, ETFs, municipal bonds, and index funds. All these tend to generate fewer taxable events. Use tax loss and gain harvesting strategically. So offset gains with losses and also consider harvesting gains in low income years. Also, time your transactions. If you expect a higher tax bracket next year, consider accelerating gains this year or delaying losses until they're more valuable. Also, you want to look at smart asset allocation. Hold tax inefficient assets like taxable bonds, certain funds, put those in tax advantage accounts. You want to hold stocks and equity funds that are more tax efficient in a brokerage account where long-term capital gains rates might apply. So again, ETFs are a good candidate for brokerage accounts because they tend to be more tax efficient. You also want to reinvest with intention. So if you're reinvesting dividends or capital gains distribution, make sure it aligns with your broader tax and investment strategy. All right, let's talk about good records. To manage your brokerage account taxes effectively, you want to stay organized and you want to keep records of purchase dates and cost basis, sale dates and proceeds, dividends and interest received, realized gains and losses, and reinvestment activity. Generally, these things are going to be recorded and documented by your investment custodian, but it never hurts to always just, track that yourself also. So it simplifies tax season and also protects you in case of an audit. So make sure you've got all these records, keep all those forms you receive. So taxes on brokerage accounts work a little bit differently than other accounts, and they can be a little bit complex, but they're manageable if you are intentional about it. One thing I like to really focus on is simplicity in brokerage accounts. You can have a lot of different investment types in retirement accounts because there's no capital gains to worry about or taxable events along the way. Both brokerage accounts, you want to keep it really simple in general. That's what I do personally. Now, if you're heavily into tax loss harvesting and you want lots of positions to have lots of opportunities for that, that's one thing. But if you're really just trying to keep it simple and just kind of minimize taxable events, keep it very simple in your brokerage account. So that is a rundown on how taxes work in a brokerage account. So as always, if you have questions about this or anything else, definitely feel free to reach out. I'm always happy to chat. You can find me on my website, which is elevationfinancial.com. And you can also book a complimentary consultation if you want to chat in real time. And I'd be happy to chat. That's at elevationfinancial.com. All right, everyone. Thanks for joining me today. Have a great day. See you next time.